Michael, a savvy investor who barely scraped by through the 08-09 financial crisis, was slowly starting to understand the power of decentralized exchanges. However, there was still much to learn about how they operate behind the scenes. If Michael could get a good grip on how decentralized exchanges work, he knew that there was a wealth of opportunities to both make a lot of money and have fun in the wild west of DEXs and DeFi. He understood that decentralized exchanges could offer massive benefits over centralized exchanges, like lower fees, limited counterparty risk, anonymity, an open community, composability, and censorship resistance. He also understood that decentralized exchanges operated peer-to-peer without middlemen or order books. But how did this all work under the hood exactly? Enter an automated market maker. Automated market makers are the underlying protocols that power decentralized exchanges. Let's walk through an example. In centralized exchanges, if Michael wants to buy Ethereum at $4,000, it's the centralized exchange's job to match Michael with someone who's willing to sell Ethereum at $4,000 or Michael's preferred value. If, for example, there's not a suitable match, that means there's low liquidity, a term used to describe how easily an asset can be exchanged. In the case of low liquidity, centralized exchanges call on parties called market makers who are willing to match orders that cannot otherwise be fulfilled. Market makers are often large financial institutions or entities with significant capital and earn fees for helping fulfill those orders. Now, over to DEXs and hence the term automated market maker. Automated market makers replace order books and allow for anyone to participate in market making. Automated market makers utilize smart contracts or contracts that execute in code that define the prices of assets and ensure adequate liquidity is provided. In DEXs, asset pairs exist in a liquidity pool. Liquidity pools are essentially a pool of funds that are crowdsourced by a bunch of different investors and help facilitate and support trades between particular assets on DEXs. DEXs and liquidity pools democratize market making, allowing anyone to become a market maker. Liquidity pools often work in pairs. For example, a popular liquidity pool is ETH DAI. For individuals wanting to participate in market making, they can contribute a predetermined ratio of ETH and DAI to the pool and earn fees in proportion to the total funds in the pool. This can be in the form of an LP token and can be redeemed for share of transaction fees when you want to exit the liquidity pool. AMMs may also provide governance tokens to traders and liquidity providers, which allows them to vote on the future decision-making of the protocol. Now, if Michael wanted to buy ETH, he could utilize the ETH DAI pool and exchange DAI for ETH. After Michael's trade, automated market makers rebalance the pool using a simple equation. DEXs like SushiSwap and Uniswap use an A times B equals K equation, whereas Balancer and Curve use different mathematical relationships. Thus, assuming Michael's trade wasn't too large of an order, the amount of ETH in the pool would decrease, the price of DAI would decrease, and the price of ETH would increase. Traders capitalize on these opportunities and could, for example, buy DAI at a cheaper price in the current pool and then sell it at a higher price on another exchange. This also helps rebalance the pool. Michael then discovered the term impermanent loss. This can occur in the ETH DAI pool. When the ratio of ETH and DAI in the liquidity pool fluctuate, those providing liquidity to the pool can incur losses as the price ratio of the assets in the pool can be different from the price at which they initially deposited. However, it is called impermanent loss since it's only permanent if the liquidity provider exits the pool at the time of the unfavorable price ratio discrepancy. After going down the rabbit hole of automated market makers, liquidity pools, and liquidity providers, Michael was in awe of the beautiful concert that is formed in decentralized exchanges. The interplay, incentive mechanisms, and game theory in DeFi were fascinating, and Michael was ready to make some money, have some fun, and become a liquidity provider in the wild west of DeFi. He would never look at traditional finance the same.